Welcome back to the Deep Dive. Today we are cutting through all the noise to give you the essential signal. We're synthesizing everything directly from a detailed market report that dropped on December 7th, 2025.
And it really presents a complex picture. You've got high rates on one hand, this intense focus on tech.
And this fascinating contradiction. I mean, traditional markets seem so calm, but crypto markets are terrified. Okay, so let's unpack this. Our mission here is pretty clear. We want to pull together the most critical data points from across the whole financial spectrum. We want to give you a clear roadmap of what actually matters right now. So we're focused on three main areas. First, what is that stubborn 4.1% 10-year yield, and what do liquidity metrics tell us about real risk appetite?
Right. And second, where is the money actually flowing?
Exactly. This hyper-concentration into AI leaders versus, the surprising caution in digital assets.
And finally, that high beta corner, the pre-stocks. We need to understand what's driving that massive private speculation.
The overall summary from our source material really gets to the core paradox of all this.
Yeah.
Global liquidity is high, baseline rates are sticky. That 10-year treasury is just holding around 4.1%.
And in traditional markets, the VIX, the fear gauge is low. Down near 15, that signals calm.
But then you flip over to the speculative side, and the crypto fear and greed index is flashing intense fear. How can the market be calm and terrified at the same time? That's the tension we're trying to navigate.
That tension is, I think, the defining characteristic of December 2025. And it all starts with that high rate foundation you just mentioned. We're not just in a high rate environment. It's persistent, it's stable, but also, volatile.
Okay.
If we dive into the U.S. Treasury data from December 4th, the numbers confirm this. The 10-year yield, the bellwether, is sitting at about 4.11%.
And the 2-year?
The 2-year is holding around 3.52%.
But it's not just the numbers themselves, right? It's the relationship between them. That 2-year versus 10-year curve is still positive. The 10-year is higher, but that spread is narrowing. What does that tell us?
It's the market's quiet hedge. A narrowing spread means investors are getting cautious. They're worried about long-term growth or maybe long-term inflation fighting or, probably both.
So when the short end is chasing the long end,
it implies money managers are pricing in a potential slowdown. Or maybe they think the Fed's ability to control long-term rates is limited. It's not an inversion yet, which would be a huge recession signal, but it's definitely signaling caution about the future.
So this caution, it must also reflect how the market is pricing the Fed's next moves.
Absolutely. Right now, the market expects the Fed to hold steady on the short-term path. But the 10-year, that's where the fight is. Long-term rate expectations are constantly being repriced with every new headline, every jobs report.
Which means funds that are sensitive to long-term borrowing costs. They're getting hit by this.
Exactly. Think leveraged real estate ETFs, infrastructure bonds. They're being affected by this constant repricing, even if the Fed isn't actually doing anything.
Okay, so stability now, but high sensitivity down the road.
Yeah.
This brings us back to those contradictory risk gauges. If institutional money is worried long-term, why does the VIX suggest everyone is so complacent?
It's a great question. The VIX, our traditional measure for S&P 500 volatility, is low. It's holding tight in that 15 to 16 range. I think it was 15.78 on December 4th.
So the traditional market is fine with risk?
It seems to be. Investors are buying call options, not scrambling for portfolio insurance. The consensus seems to be that equities will just keep drifting higher.
And then there's crypto.
And then there's crypto. The crypto fear and greed index tells the opposite story. It's down around 20, 22. That is intense fear.
How do you reconcile that?
Well, are retail traders genuinely terrified? Or is that index just not capturing the institutional money that's keeping prices up? The fact is, the risk appetite is split. Calm confidence in the S&P, deep caution in Bitcoin.
And all of this is happening on top of a just staggering amount of liquidity.
Precisely. We have to acknowledge that. The dollar index, the DXY, is near 99.0. So the dollar is robust, even with a recent small pullback.
And the money supply.
Even more important, the M2 money supply hit about $22.3 trillion as of October 2025.
Wow.
Yeah. Now, the growth rate has slowed way down from the post-pandemic peak, but that massive $22.3 trillion, that's the baseline. That's the cash sloshing around looking for a place to go.
Forcing investors to ask, where can I put this money where it'll actually beat inflation?
That's the question.
And we can't talk liquidity without mentioning the Fed's tool for managing all that excess cash, the on-N RRP.
Right, the NY Fed's daily reverse repo operations, it's critical here. Think of it as the Fed absorbing short-term liquidity, usually from money market funds.
So it puts a floor under short-term rates.
A very effective floor. And the fact that it's still being used so actively, it signals there's a massive amount of cash outside the regulated banking system that needs constant management. It keeps pressure on that short-term rate environment.
Okay, here's where the story pivots. From the macro big picture to execution. And this is where it gets really interesting for me. You've got $22.3 trillion looking for a home. The 10 years giving you a decent 4.1%. So why are investors concentrating their risk so much?
It's the Tina mentality. There is no alternative.
Leading to these targeted, high-conviction bets in technology.
Exactly.
Let's look at the public markets. They're broadly strong but focused. VOO, the S&P 500 ETF, closed at $630.48. QQQM, the NASDAQ Q100, at $257.53, both up a little. But the money isn't just going into the index, is it? It's going into the engine that's driving the index.
And that engine is the AI thesis. The flow data is unambiguous. Investors are relentlessly chasing the AI and large cap leaders. They're betting the infrastructure build-out is just getting started.
All right, so NVIDIA is trading steadily around $182 to $184. Just constant demand for its chips. Meta Platforms, Meta, at $673.42. A phenomenal recovery.
And that's driven by more than just ads. It's high expectations for their AI model deployment and efficiency gains.
Even a volatile name like Tesla, TSLA, around 455, it seems stabilized. It's benefiting from that tech perception, the robotics, the autonomous driving.
Now let's step across the fence into crypto, where prices are high, but the internal sentiment is just dominated by fear.
So long-term holders are keeping the floor high, but the short-term retail crowd is spooked.
That's what it looks like. Bitcoin, BTC, is still commanding around $89,000, trading in a tight range, maybe $88K to $91K. Ethereum, ETH, is holding firm in that $3,000 to $3,150 band.
What about some of the others?
Solana, SOL, is around $130 to $133, some minor pullbacks. And even newer high-volatility community tokens like HYPE are active, trading around $30 to $31. So niche speculation isn't totally dead.
To really gauge the conviction here, we had to put Bitcoin's valuation in context against, a true legacy asset, gold.
Yes. If we use Bitcoin at $89,000 and gold hovering around $4,200 an ounce, the ratio is between 21 and 22.
One Bitcoin buys 21 to 22 ounces of physical gold.
Think about that. 22 ounces of physical gold. That's tangible wealth going back centuries. The fact that one unit of this 16-year-old digital asset commands that much value tells you everything. It's about the long-term capital bet on scarcity and future utility, regardless of the short-term fear index.
And that valuation is clearly reflected in the public companies tied to the whole digital ecosystem.
Yeah, you see it in the stock prices.
Circle, CRCL, is stable near 85.6. Its price is less about speculation and more about its core business. Stablecoin regulation, compliance, that's been positive.
Coinbase, Coin9, at 269 to 270, that's a purer play. It moves in sync with BTC volatility and trading health.
And then Robinhood, HID, at $131.95, still showing significant volatility.
And its price action is driven by news, by product launches, general retail trading volume, which has been uneven. The difference between Circle and Robinhood really illustrates the split between regulated infrastructure plays and consumer trading platforms right now. Which brings us to the highest risk, highest beta segment of the market. The place seeing the fiercest capital flow, pre-stocks.
Right. These private company shares, or SPVs, that give you access to pre-IPO mega companies. Define that frontier for us. Why are pre-stocks the definition of high beta right now?
They're high beta because of the unique risks. Illiquidity, valuation opacity, and often a lack of disclosure compared to SEC-regulated stocks. These shares trade on secondary markets where price discovery relies almost entirely on, the last financing round or just pure market sentiment.
And AI is dominating here too.
Completely. Anthropic has incredibly positive sentiment, fueled by massive continuous financing. We saw their Series F earlier this year. Likewise, XAI is all about high valuation and high attention. The constant reports of big financing negotiations are what's driving their secondary market price.
And the ghost in the machine is still OpenAI, surrounded by all these listing rumors.
Absolutely. The OpenAI pre-stocks are heavily watched. Public reports are suggesting an IPO for late 2026, maybe 2027. And just the anticipation of a future liquidity event keeps that premium intense, even if it's 2 years away. Investors will take on enormous risk for that potential multi-bagger return when these giants finally go public.
Which explains why the news sensitivity is so high. That Elon Musk denial about the SpaceX valuation was a perfect example.
A perfect illustration. The market reacts violently to those rumors because these valuations are built on perception. Musk's denial highlights that these numbers are often just targets or negotiating points, not established fact. It reinforces the need for strict risk management in the sector.
Okay, so the market is stable but sensitive. The money is flowing into very specific areas. What are the immediate catalysts we need to watch for that could shape the next week?
Well, the biggest one is regulatory progress in the digital space.
We have a major positive signal there. The CFTC announced it will allow the operation of listed spot crypto products under a new compliance framework.
And that is a massive step. It's institutionalization.
Yeah.
It's moving crypto out of a legal gray area and providing badly needed clarity.
But it's not all clear skies, is it?
No, that CFTC news is great for future growth, but ambiguity is still a headwind. We're seeing these intensifying disagreements between the SEC and others about tokenization and innovation waivers. If you're a learner focused on high-growth assets, you have to watch this. Those waivers dictate what assets and how they can be legally sold next year. A lack of consensus will slow things down.
And outside of digital regulation, there were a few traditional market events. President Trump signed an executive order on the food supply chain work group. It seems disconnected, but these things affect the long-term inflation outlook, input costs for consumer staples.
And we're still seeing strong capital flow within the crypto industry itself. VC activity, M&A like Paribu acquiring Coinmonada. It shows that while retail is fearful, venture capital is still pouring money into the infrastructure.
And on the risk front, that earthquake in Alaska.
Right, a magnitude 7 near Yakutat. Those regional risk events immediately get the attention of the insurance market. It affects catastrophe bond pricing, reinsurance rates. It's a niche but important financial indicator.
That is a comprehensive synthesis. So let's pull all this data together. Based on these conditions, the high rate, low VIX, cautious crypto, what's the most advised strategy from the source material?
The overarching strategy is discipline. First, maintain your defensive core positions, your VOO and QQQM. And given the high conviction around AI, you can gradually increase exposure to the leaders, your NVIDIAs and Metas, but always on pullbacks and according to your personal risk tolerance.
What about crypto?
For crypto, position management is everything because of that fear index around 20. You'd recommend dollar cost averaging, or DCA, into Bitcoin near 89K and Ether near 3K if you have a long-term horizon. And avoiding short-term leverage is it's a must right now.
And the extreme volatility in pre-stocks, what's the advice there?
Treat pre-stocks Anthropic, XAI, OpenAI as what they are. High volatility, high payout speculative plays. Our sources suggest keeping positions small and diversified with strict exit strategies like stock losses. The valuation transparency just isn't there yet.
And a hedge.
And finally, yes, given the 4.1% tenure and the volatility in long-term expectations, consider a small allocation to short-duration Treasury ETFs. It's a tangible hedge against any unexpected rate increases.
So as we wrap up, what should we be monitoring most closely over the next few weeks? What will genuinely move markets?
The watch list is focused on macro and regulation. You need to follow any new Fed statements and the big macro data releases, specifically CPI and NFP, because they feed directly into those rate expectations. On the regulatory front, watch for tangible progress from the CFTC and the SEC on those key issues. And finally, watch the capital actions from the AI leaders, OpenAI, XAI, Anthropic. Their financing events set the premium for the entire pre-stock sector.
That is a phenomenal breakdown of a deeply contradictory market. And that contradiction brings us to our final thought for you to chew on this week. We've established that the stock market's VIX is very low, around 15, which signals widespread traditional complacency. And yet the speculative alternative segment crypto is simultaneously priced incredibly highly, with that Bitcoin to gold ratio at 21 to 22 while it's experiencing intense internal fear.
The big disconnect.
It's a profound disconnect. So if traditional risk indicators suggest stability, what hidden factor is driving it? Are investors just hoarding digital assets despite being scared, waiting for regulatory clarity? Or maybe the real fear isn't in crypto itself, but in the long-term devaluation of fiat currency, making Bitcoin a necessary, albeit terrifying, hedge against traditional market stability. Food for thought until our next deep dive.